Welcome back. The U.S. Federal Reserve Board, of course, will make an interest rate announcement later today. Not a whole lot of surprise about what that announcement is going to be. It'll be a big surprise if the Fed reduces its rate. Our next guest, meanwhile, is bullish on U.S. growth and sees the Fed on pause in 2025. For her investing outlook in this scenario, we're joined now by Mina Krishnan, multi-asset portfolio at Schroders. Thanks for coming by.
Thank you.
So you don't expect a rate cut today, but you do say you'll be looking at the finer points of what the Fed has to say. What might that include?
Yeah, that's right. We do expect the Fed to remain on hold for the duration of this year. And so we really want to look in between the lines, especially because today we are going to get a refresh of their SEP. As an asset allocator, what really matters for our portfolios is the equity bond correlation. And what we've seen really since 2021 is that in their SEP, the Fed participants have been rating a higher upside risk to core PCE and to PCE. And that really coincides with the time when the equity bond correlation started to flip positive. So given that our view is that we are in a stagflationary environment, that stag versus inflation trade-off, that's something that we think the SEP can help shed light on how are participants thinking about that trade-off between growth and inflation.
SEP is the summary of economic predictions, otherwise referred to as the dot plots, correct?
Correct.
Where Fed members see interest rates into the future. That's an out-of-consensus call that you and your colleagues have. No change in the Fed funds rate for the duration of 2025. As you well know, most Fed watchers are expecting 2 or 1 cuts. Why do you see no cut coming in 2025?
Yeah, as a team, we've tended to be more bullish than consensus. And the upshot to that is we also tend to be more hawkish than consensus. So we do see the Fed, we believe the Fed when they say they are going to be patient and data dependent. And we think this reflexive habit that the market has of chasing rate cuts every time the data softens, we do think that's a symptom of the previous decade, the old regime. And the fact that inflation is still elevated, that does complicate the Fed's reaction function more so than investors believe. So we do see the Fed on hold for the remainder of the year. That said, in the aftermath of Liberation Day, we have moved our forecast in a stagflationary direction. And on back of some of that weaker growth data, we do expect the Fed to cut rates next year, though, not this year.
So what is your view of U.S. tariff policy and inflation and economic growth in the future in the U.S.? Because the view of many is that we will see an effect on economic growth in the United States, a negative effect on economic growth that will lead the Fed to cut rates if it sees inflationary pressures ease. You see things differently, at least in the time horizon that you see these changes coming in. Is that correct?
So for 2025, we are not looking for a recession. We think recession is not likely for 2025. We have moved our forecast in a stagflationary direction because we believe that ultimately the tariff rates at these levels will be somewhat manageable. So if we see tariff rates persisting even after the 90-day pause, we have moved our growth forecast down for 2025. But we do see a recovery on the horizon in 2026, and we do see growth and inflation continuing its disinflationary path in 2026. So at these levels, we do see it being manageable for the economy. We are looking for, though, a bit of a soft patch this year.
One of the economic indicators you're watching most closely and will watch most closely moving forward is jobless claims.
Yes.
Why so?
Yes, because we are in a low, higher, low fire environment. Powell has talked about this before. And in a low, higher, low fire environment, I think too much weight is being placed on hiring data like the non-farm payrolls that get released every month. Because in a low, higher, low fire environment, by definition, hiring is going to be soft. But I don't take that as a signal that the labor market is cracking. I think what's more important is that firing side of the equation, whether or not that changes. So jobless claims, which just got published today, is the one that I am really watching very closely. You do see seasonally there is a bit of softness in the summer, and so I wouldn't be surprised to see a bit of a growth scare, similar to like what we saw last year in August. But big picture, the trend of jobless claims this year is very much tracking in line with the trend from previous years, and that gives us comfort that the labor market is in good shape.
You're positive after all of this on equities.
That's right. Compared to the start of the year, though, I will say our confidence in that view has actually risen, because at the start of the year, what we were really struggling with in our pro-risk views and our positive view on equities was the fact that it was so consensus, right? You know, after 2 years of back-to-back 20% plus gains, how can you be bearish? So in the start of the year, it was a very consensus view. Now we are still positive, but we have more confidence because it's no longer consensus. After Liberation Day, you still see a lot of residual nervousness left in the market. When I look at things like the AAII total stock allocation, portfolio weights in equities have dropped from 70% earlier this year to 64% now. And when I look at the trend, for example, S&P 500 versus this 200-day moving average, we're not as extended as we were earlier this year. So positioning and trend give us higher confidence in that view.
Do you have a target on the S&P 500 and a horizon?
So target in terms of the S&P 500, I like to think about in terms of how it's trading versus the 200-day moving average. The 200-day right now is around 5,800. And historically, when you look back over decades, what you see is that the S&P tends to peak when it trades between 10 and 15% above the 200-day moving average. So at these levels today, I would start to get a little bit more conservative on equities, around 6,400 to 6,600 on the S&P.
What do you see and what's your view of non-U.S. stocks?
Yeah, we think diversification is really the best form of defense in this environment. Macro uncertainty is still very high. And so, again, our mantra, diversification is the best form of defense. In the first half of the year, it really paid to diversify into Europe. For the second half of the year, we're looking at Japan and emerging markets where valuations there are still more attractive. And so combine that with our view that the dollar will continue to weaken. We think those are important tailwinds for those emerging markets and Japanese markets.
European stocks have had a good first 6 months, nearly, of 2025. Germany in particular, the London, Paris are also up pretty significantly. There they are today. I can get viewers a snapshot of how they've positioned themselves so far this year, what their gains are this year. And you tell me, Mina, your view of European stocks. Are you backing off now your earlier bullish call on European stocks? London up 8% so far this year. Paris up 4% so far this year. The DAX in Germany up 17% so far this year.
Yeah, we see Europe kind of caught between opposing forces. On one hand, you have the tailwind of repatriation flows, and we see that when we look at European area listed ETFs in Europe, you do see that strong inflow as investors bring money back home. But on the flip side, we do think the stronger euro does pose a risk to earnings. We have seen European earnings get downgraded quite significantly this year, around 3% now expected for 2025. And this is coming off of 2024 when earnings growth in Europe was negative. So that fundamental picture is being worsened by the stronger euro. You're also seeing that happen in the relative earnings revisions, where revisions are being downgraded faster for Europe. So we do see the European market kind of caught between these opposing forces. On the one hand, again, positive tailwinds from investors bringing back money home, and on the other hand, headwinds from the stronger euro and earnings growth.